I'm just going to get going with the talk. I think my title slide probably sums everything up quite nicely, assuming it comes up here someday. There you go. That pretty much covers the situation, I think. I can probably sit down now. It was one of those weeks, and your mother was right. There will be weeks like this. They happen occasionally in the market, and they actually need to happen occasionally in the market. The truth of the matter is, part of the reason why we had a week like this, aside from the obvious one with the virus fears and everything, I mean, I'll go into it again and sort of in the presentation, but it's important to keep in mind, you know, after the last, you know, the great financial crisis, if you will, there was this real focus on black swans. And the truth of the matter is, you know, several people got fairly famous for talking about black swans, and they all make it sound like these are individual things that come out of nowhere and they completely disrupt things and nobody could see them coming. And the truth of the matter is, black swans are black swans because of when they happen, not just because of what happens, but because of when they happen. Quite often what makes an event a black swan is the fact that you've got a market backdrop when they occur where, quite honestly, people were looking for a reason to sell, and they were given one. If this virus had happened, not that it's not a bad thing. None of us knows where it's going to go at the end of the day. But if what we've got today with the virus had happened in, say, 2010, 2011, personally, I think it's very unlikely it would have had the market impact that it's had in the last week. It partially had the market impact because the major markets were overvalued already. Everybody knew it. Nobody was admitting it, but it was no big secret. So I think it's important to keep that in mind. I always like to bring this one out when we have a week like this. This is a painting that I like quite a bit. It also sums up the situation nicely. This, if you don't recognize it, is a very famous painting called The Scream by Edvard Munch, great Norwegian impressionist painter, late 19th century. I'm quite fond of this one because it, helps us get us all in the mood. So basically, everybody's freaked. One thing that obviously has come up repeatedly in the last 24 hours, and again, I don't blame anybody, is what the hell's going on in the gold market? How come gold got sold so hard? This doesn't make any sense. Gold should be going up in this situation. Yes and no. A couple things to keep in mind is when you get a market and what I call an illiquidity event, which is really just a polite way of saying panic, where you got a whole bunch of people looking for an exit, where you've probably got a bunch of people getting margined, frankly. When you get that kind of market environment, people are not just going to sell what they want, they're going to sell what they can. And we tend to forget, and I would say gold bugs especially, and I don't classify myself as one, they tend to forget that the gold market, particularly the future side of the market, is actually quite large. It's not a small market. It's actually a very big market. It is a market you can actually move a lot of money around these days. It's not the treasury market. It's nowhere near that scale, but it's pretty damn big. So if you're in a situation where you've got to get some cash, it's not a bad place to get it. And I think it's also worth remembering there was a lot of, shall we say, late money in the gold market. There's a lot of money came into the gold market in the last couple of months. A lot of that which was hedge fund, private equity money. They aren't people that have a huge long-term conviction about gold or bullion. I mean, they're basically Momo. They were momentum traders, and those guys tend to turn tail pretty fast. So, in that sense, it's not really that shocking. One thing to keep in mind too, I'm hoping this is encouraging, not the sign of things to come in the next 3 months, but it's also worth noting that the drawdown this week was extremely rapid. It was, in fact, the fastest move from the top to a 10% correction in history. Normally, when you see moves that fast, it doesn't take long for the bottom to show up. That's not the same thing as, I'm not necessarily saying the bottom is going to be 0.5% from here. I'm just saying wherever the bottom is, I don't think it's going to take long to get there. I think it's probably going to happen pretty fast, because that's normally what happens when you see this deep, this fast, this deep a move. The bottom tends to come fast. I don't know yet whether it's going to be a V bottom, but the good news is wherever it's going to get, it's probably going to get there pretty fast. Now, I want to do a couple of compare and contrasts, again, and this is kind of to address everybody freaking out yesterday about the gold price. If you take a look at those two charts, one on the left S&P, one on the right's gold, they're basically 6-month charts, give or take. If you look at the S&P, what happened in the last week, 13% drawdown from the top. It's trading back at October levels. Gold, which had everybody terrified because of the move yesterday, was about a 7% drawdown. It's back to February 18th levels. Gold is trading where it was 2 weeks ago. And everybody's shitting gold bricks, shall we say. It's not good. I'm not happy about the way I traded yesterday, but I think you need to keep a little bit of perspective. The next compare and contrast chart, assuming that things are going to get uglier, which they may, I think is also an important one. These are also roughly 6 months charts. This is 2008 to early 2009. I'm sure most of you have pleasant memories of that period like I do. You can see the S&P on the left again. The drawdown, top to down drawdown, we all know was about 50%. We're only looking at part of it there, but it's interesting to note that when things really started to dive there in October, November, gold dropped, but then started to move higher. Notice that gold actually bottomed in late October, early November, just as things were bouncing and then rolling over again in New York. New York didn't actually bottom until we were into March. Gold bottomed 5 months before the S&P did, and the gold price had moved up 40% by the time the S&P bottomed. That's quite often what you see in these situations. Gold doesn't respond well to illiquidity, and by that I mean it's a big enough market that you can do a lot of selling in it if you need to raise money, but it's not a big enough market that you can do unlimited selling without really moving the price. What it does tend to respond very well to is two things: insolvency, so that is when the shit really hits the fan, companies start going under, people really start freaking out, gold tends to get bought hard. It also responds well to the tools and techniques that are used by central banks and governments to try to calm and reverse a panic or a crash. So essentially the fiscal and monetary tools that tend to get rolled out during periods like this, almost without exception, are very gold positive from one end to the other. So they tend to really help the gold price, but that's not something that happens until you see the government really start reacting to the situation, which, keep in mind, they really haven't yet. When you look at Western governments, Canada, the States, most European governments, most of them haven't done anything yet. I suspect it's coming pretty soon, though. So where do we go from here? And again, this is just goes back to the comment I made a little bit earlier. That chart you see there, it's a little small, but that's basically the length in time in days that it took for the market to get from its top to a 10% to a correction, essentially, to go down 10%. And that's all of them going back to like the early 50s. That tiny little red mark on the right side, that's the current one. It was the quickest, 6 days from the top to a 10% correction, fastest that it's ever happened. Because normally when you see a major market top, and this, if you want to be optimistic, this may be a hint that maybe this isn't a major market top. I'm not personally sold on that, but if you want to be optimistic, major market tops almost invariably tend to be these broad, rounded things, and the real selling that everybody remembers actually comes 2 or 3 months later after the top. You don't generally see this kind of, people talk about crashes and falling off a cliff, but that's not actually what usually happens at major tops. You usually see these slow, rounded tops, and then things get steeper and steeper and steeper. In this case, it pretty much fell off a cliff. 6 days to get down 10%. And like I said, usually the faster these things happen, the steeper the curve is, the quicker you get to the bottom. The bottom might be another 10 or 15% lower ultimately, but it's not going to take long to get there. And I don't really have strong conviction of where the bottom is going to be yet, to be honest. I'm kind of expecting it to be lower, but I just don't know how much lower yet. Longer term, obviously, this situation with, and again, I'll stress again that part of the reason why we're selling off this hard is the market was very overvalued. It was a balloon looking for a pin, so it's not really shocking that we saw this kind of selling. And really what's going on now is we've shifted from it being strictly just a market event to really being more of a political economic event. A lot is going to depend on how governments, media, everybody responds to this. And I think what people want to see, what the population wants to see, is some kind of measures that give them comfort that people that are in charge or people that know what they're doing are on top of it. There you go. We're apparently not there yet. But and not to say that they've got some great, like they've got some great answer or there's a silver bullet or anything like that, but just that they're actually doing something. And I think part of the reason why the markets reacted so negatively this week was the sense among traders, correct, I think, that the market, governments really hadn't done anything yet. They were sort of deer in headlights. But I think given the pressure and given the markets, I think we'll probably start seeing Western governments and probably Western central banks too start responding fairly quickly. And to give you a sense of where we are with different things, if you look at the chart on the left, and it's a white on black Bloomberg chart, it's not that easy to read, but just look at basically the bottom right corner. What that is the China's PMI, their Purchasing Managers Index, and this is for February. This came out last night. This is the manufacturing side. Talk about falling off a cliff. That's the lowest reading they've ever had for a manufacturing PMI. And the manufacturing PMI is actually the good news. The service PMI, and keep in mind, PMIs are the way that the survey's done. 50 is basically the 0 point. If it's above 50, it implies growth. If it's below 50, it implies contraction in the economy. This came in at about 36 on the manufacturing PMI. The service PMI, which China and the manufacturing one's still more important. It's not like North America where the economy is mostly services, but still the service sector is getting bigger and bigger. Service PMI in China was like 27. Which is really ugly. That's a really, really, really ugly number. But it's not surprising. You think about the fact that there were basically 300 or 400 million people in quarantine. I would have been shocked if it hadn't fallen off a cliff. I mean, I would have just assumed they'd made the number up if it was much better than this. On our side of the ocean, if you will, one thing that I think is a pretty, well, it is an important sentiment indicator, and obviously it's an important market. That's simply the 10-year yield chart there. Again, it pretty much fell off a cliff too. 10-year yields ended the week below 1.3. They've never been that low ever in history. That's both good news and bad news. I mean, it's bad news in the sense that obviously people were freaking out and hiding out in the bond market. The good news is there is a balance and a trade-off between yields and equity returns. So if you get yields drop enough, it will have a positive impact on equity returns. You do get to the point where people in the bond market go 1% yield, 0.5% yield. I mean, screw this, I'm just going to jump back into equities. I mean, there's a reason why Fed rate cuts work. I'm not sure how well a Fed rate cut's going to work right now, since, like I said, the problem isn't really, it's not really a market problem, it's not really an economic problem. It's a fear issue with the virus. So I think, personally, I think what's more important is that governments are seen to be doing something that should be effective. I'm not sure the Fed cutting rates is going to make that much difference right now, but I suspect we're going to see it. If you look at the current yield curve, right now the market's pricing in 160% chance of a rate cut at the next meeting, and about a 90% chance of 2 rate cuts this year and about 70% of 3. Basically, the bond market's pushing pretty hard to get rate cuts. And yes, if we get rate cuts, that is positive for the gold price. So I'm just going to run through I realize these charts are quite wordy, and of course, because I didn't even bother trying to do this before last night because this week was so insane. What I will probably do is ask Matt if he can just flip a copy of this deck to everybody, save you having to scribble all the stuff down. Nobody knows where things are going to go with this virus yet. The one, positive, I guess, if you want to call it that, is the last 2 or 3 times we've had had outbreaks like this, the market did tend to overreact. I do think there's very little doubt that COVID-19 is going to be worse. I mean, it's already worse than SARS. It's really worse than any of the recent ones. I suspect it's going to get worse or it gets better in terms, there's going to be a lot more cases. What I'm hoping is that morbidity won't be as bad. Western medical systems, especially places like Canada and most of Europe, really, where you've got essentially Medicare for all. I mean, that is going to help. People will be able to go and get something treated right away. I don't think the rate's going to be that bad, but there's going to be a lot of people catch it, and there's going to be a lot of people get very sick. So, and the impacts economically aren't really. It's not even just from how many people get sick. A lot of the impacts are based on things like containment issues, quarantine. That's really the problem in China. I mean, obviously, 80 or 90,000 people getting it in China is a big issue, but what really made those charts fall off a cliff is the fact that they had to set up quarantines. A lot of people are saying, I'm not going into a factory with 5,000 other people until I think this is passed. I mean, that's the kind of stuff that's very hard for anyone to manage, and I don't know how well it's going to get managed here, but those kind of impacts will be important. And I think things like, quite frankly, the PDAC is going to be an interesting test. I'm quite curious to see how much lighter the attendance is. It's going to be lighter for sure. I know a whole bunch of people that aren't coming, that were coming a week ago. So that kind of stuff creates slowdown. So I think the odds are this is going to be a pretty shitty year for earnings. S&P 500, I think you can throw the 15 or 20 or whatever fantasy number was there for earnings growth this year. You can throw that out the window. I suspect it'll be zero, and I think most companies will be happy if they get that. So, I mean, that's part of the reason why I'm not sure we're at the bottom yet when it comes to New York. But we may be at the worst part of the fear phase, but we may have a little more downside to go. Essentially, markets in this kind of situation, markets bottom when traders think they know everything, and by that, it doesn't matter whether they're right about knowing everything, it's whether they think they know everything, which is just a roundabout way of saying when they think the information's all out there. It's the unknown that tends to drive the kind of selling that we saw during the last week, is you just don't know how bad it is. So a lot of traders just go, I'm going to sell first, I'll figure out where it is later, I can always buy shit back. I'm just getting out for now. In order to really get a sustainable bottom, there's got to be enough information out there, there's got to be enough transparency that whatever the situation is, however good or bad it is, traders have comfort that they can measure it and get their head around it. And that's where things bottom. That's where people say, I've got enough information and enough clarity that I think the buy level is X, whatever X is. That's what gives you a bottom. We're not quite there yet. I'm hoping we'll get there fairly soon. I'm honestly expecting to start seeing government announcements like over the next 48, 72 hours. Whether it's anything useful, who the hell knows? But I think you're going to start seeing them just to be seen to be doing something, and that may give people some comfort. I mean, as I said earlier, bond yields down below 1.3. Yields get low enough that does put a floor under equities. There is a trade-off there at all times between bonds and equities, and no two ways about it. Bonds were definitely the place to be for the last couple of years. The world's longest bull market, which is not actually equities, it's actually bonds. The bond bull market's far longer than the equity ones. Everybody, including me, has declared the end of it 2 or 3 times in the last 3 years. We're obviously not there yet. Below 1.3, we can't have a hell of a lot farther to go, frankly. But it does feel like you're going to see 10-year yields get below 1%. It looks like it's going to get there, which I didn't think would happen even a month ago. The good news on the gold side, notwithstanding what happened yesterday, what's happened with the yield curve, you have seen another inversion. That's not great news economy-wise. Yield curve inversions, although they've gotten dismissed as they always do in bull markets, do in fact have a pretty good reputation. They don't have a reputation for generating a lot of false positives. They have, over the long term, probably been one of the best forward indicators of recessionary conditions, and we've had them invert twice now in the last 12 months. They're inverted right now, so I think the odds of at least a mild recession starting maybe last week, are actually pretty good. The good news on the gold side is those same yield moves have again created basically negative real yields, negative after inflation yields all the way through the yield curve. That's, in my mind, that is the best predictor of higher gold prices. It's the most, it's long term, it is the most consistent predictor of higher gold prices. It's not the US dollar, it's not stuff like that, it's negative real rates. Generally speaking, negative real rates are good news across the commodity space. They haven't been helping base metals and oil for obvious reasons, because base metals and oil have one big customer, and that big customer is China. So there's no getting past the fact it's going to take a while for base metal and oil to bottom out. They're going to bottom out when China does. But for at least on the precious metal side, negative real rates are, in my opinion, the best indicator that you're going to see higher gold prices. And that's what we've got right now. And like I said, gold tends to get sold early in panics. It gets sold during illiquidity events. It gets bought during insolvency events. We're in the illiquidity now, probably starting even to come out of that. The insolvency is going to come later when we see just how bad the situation is for companies that have had broken supply chains, layoffs, stuff like that. That's the period where gold tends to get bought. So I would say we probably have another upswing pretty much dead ahead of us right now. And gold stocks themselves, gold stocks are stocks. Unfortunately, I'd love to tell you they're going to move in lockstep with the gold price, but they never have in the past, so I've got no particular reason to assume they're going to in the future. Everybody keeps expecting them to do that, but they don't. Gold and equities don't trade the same way. Gold stocks are still stocks. So there's still, you still saw a bunch of people panicking this week. You saw a bunch of people having to sell, certainly across. I had intraday screens open on a whole bunch of the stocks that I follow in the newsletter, and there's no two ways about it. I saw at least 3 or 4 periods of what I thought was clearly margin calls, where I could see very large hit every bid sales on multiple stocks out of the same brokerage house at the same time. And that's usually a fund getting a call going from the broker going, sorry, we got to do it. And I saw several of those during the past week. That's where the really big move downs were on a bunch of stocks. So, hopefully we got through some of that. Keep in mind, like I said, a lot of the money in the gold arena in the last couple of months, that was very leveraged, hedge funds, low volatility players. A lot of people were trading the buy gold, sell volatility. The buying gold part wasn't a bad idea. The sell volatility part was a horrible idea. Anybody who's on that side of the volatility trade in the last 2 weeks got killed, totally got wiped. There's probably a few hedge funds that are out of business. We just don't know it yet, but we'll hear it over the next 2 weeks. But, again, I think longer term, medium term, I'm not concerned about gold. I still think we're going to see higher highs. And by higher highs, I mean higher than 1900, higher than any historic high. I think that's still coming. I think what you look for, and I have a collection of them happily to my left, who are going to tell you about their companies. You look for companies with strong management, good projects with preferably high-grade targets. I don't really have a problem with open pit stuff, but high-grade just seems to have gotten the market's attention more. So it's no coincidence that a lot of the companies you're about to hear from have high-grade stuff. Ideally, in this kind of a market, you want companies that are funded, because even if you're a gold company, if you get great targets, when things are this uncertain and people are this nervous, this is not when you want to be running around trying to close a placement. As it happens, all of the companies on my left, I can assure you, are all very well funded. They're all about to start doing work, or will be doing work in the next couple of months, generally fairly large drill programs on high-grade targets. And I think you're still going to get positive reactions to discovery news, and that's what a lot of these guys can deliver. And the last guy looking lonely there at the left end of the table is actually a base metal guy, but it's a company that's going into production. They're actually in production now, and yes, the copper chart looks like what the copper chart looks like, but the real thing for them is showing that their production, their ISR works, that they can grow their production, because it's something that's got a very low, their cash cost is very low. So as long as they can show the market, yes, this production system that we put in works and delivers it, they'll be fine. And, they're quite a bargain right now.